And Jonathan, I'm unmuting you, and then I'm going to be showing your website.
Good. Can you hear me?
I can, Jonathan. Great to talk to you again, buddy.
Been a while.
Yeah, I don't know how many years. Do you? I think we've gotten a little older.
Yeah, it's probably 3 or 4. Yeah, I just turned 65, actually, Dale. So,
Oh,
you can disregard everything I say.
We're the same age, huh? So, yeah, what a great. Okay, everyone, this is what happens when two dinosaurs get together and talk about markets and retirement. So, we still have one leg outside of the tar pit, Jonathan. And, I love your new mission. I'm so glad I reached out to you. But why don't we start with your headline? I'm showing your website right here. Is it wise to sell in May and go away? Hasn't worked in 5 years. What are you thinking in here?
Well, this is a guest blog by Adrian Mastraki, who is a financial advisor in Vancouver. He himself, just to the theme, has already passed the age of 70, and he hasn't plans of slowing down anytime soon. I guess he's like most people. It's like market timing. I know there are some people who believe in the seasonal trading, and then once in a blue moon it actually may work. But I think for the most part, when you consider the tax events and the trading costs of trying to be right, both getting in and out, you're just best to keep to the pattern. Keep to the program and maintain your strategic asset allocation, and keep in mind your long-term goals. Now, as far as I'm concerned, as a semi-retirement, I talk about the glide path to retirement, where retirement is no longer a instant. Like if you see an airplane and it's going to land in Seattle, for example, it doesn't start the descent when it's above Seattle. It starts like hundreds of miles away, right? Very gradual.
Right point.
That's the way I look at retirement as well. So
okay, all right. So let's get into your passion, and let me be frank. Having been a trader, and I always, I'm pretty public about my life, Jonathan, because I want people to learn from my mistakes. And this is a very interesting topic, because guys like me are really only supposed to, traders, have about 10% of our assets in a speculative arena, correct?
Yeah, I look at that. For example, I listen to Jim Cramer on his podcast. It integrates as part of my walks. People think he's a crazy, mad individual stock guy, but actually, if you listen to him, mad money is just like you say, the 10% of the money you can afford to lose on individual stocks. He's actually an S&P 500 indexer for the first $10,000, which will surprise people who don't really listen to that particular show. So,
okay, that's important, because Jim used to run a hedge fund, so he also had a lot of tactical things that he did, and as traders, we think that we know markets. So why do we need a long-term plan if we're always going to be right short-term? The problem is we're not always going to be right short-term. Sometimes our shorter-term biases take us off track from a longer-term weekly, monthly trend, macro trend. So why don't we get into how people can discipline themselves, and when you have windfalls and speculations, where do you tell people to put that money?
Well, I'm more of the strategic. In fact, Vanguard, at least in Canada, now you notice from my website that there's a lot of ads there, so take it with a grain of salt. But I was always a big Vanguard fan long before I worked with them, because I thought they were the best deal for the investor. They were tax efficient, low cost, can't beat it. And they, at least in Canada, and I think in the States, came out just recently with these 3 asset allocation ETFs. And they're really the only, with 22 basis points, 0.22% expense ratio, which is half of any robo-advisor even. And I sometimes worry, and maybe you do too, if you have a partner, if you're no longer around there to make decisions for them, what are you going to do? You're going to find a high-priced advisor, or you can just keep what you've got and just say, look, I trust Vanguard's asset allocation. They'll let you choose between 80% equities or 60% fixed income if you're conservative, grow, and balanced are the three. And I think the vast majority of people could benefit from that kind of approach. It doesn't have to be complicated. This stuff shouldn't have to be rocket science.
You know what? I think what a lot of people have in their head, Jonathan, is what happened to them in 2000 and 2008. And even though they had diversified portfolios, had a portion in cash, portion in bonds, maybe different sectors in the market, it really didn't save them from the pain. And a lot of them won't even open up their statements for a period of years. So, what do you say to people that still have that pain registered in their market memory about staying the course, like a guy like John Bogle would say?
Well, I'd say that you have to diversify among product, not just asset classes and geographies, but also even investment products. And I think in the case of annuities, the people who would have had partly annuitized, like you could say, well, what annuities do I already have? If I have an employer-defined benefit pension plan, maybe that's an annuity, though those are become rather rare. Social Security is going to be basically an annuity, inflation index. But if you have nothing but a 401k or defined contribution pension plan and it's completely in the market, up and down with the market, then I think you need to pensionize that nest egg partially. I'm here in Canada. We have an author who wrote a book on sourcing retirement income, and he himself was really quite nervous. Same age as you and I, Dale, 65.
Okay. Uh-huh.
Quite nervous about the fact his market exposure. So his recommendation, I wrote about it in Money Sense magazine, was to partly annuitize, even at 65, which is really the most. Most people say late 60s, 70s, even 80s to annuitize. He said, no, annuitize, if you don't have any other annuities, no pension, no corporate pension, defined benefit, then annuitize 30% of your financial assets at age 65. And then at 70 would be Social Security, because most people will say, if you can do it, avoid taking a Canada pension plan or Social Security until 70, because it's going to be, 40% higher than if you did it at 65 or 62. And then that's sort of like the second tranche of annuitization. So at 65, you do it with a real annuities from an insurance company for 30% of the portfolio. Social Security kicks in at 70, and then at 75, you kick in the second 30% of your remaining financial assets. That is one way to handle stock market fear.
Okay, so I want to talk about annuities for a minute, because they get kind of a bad rap with some commercials on CNBC, and in my own experience, found that a lot of salespeople gravitated towards annuities because of such a high payout that they got. The commissions at times were close to 10% of what was annuitized. Is that correct, or is that a misguided?
Well,
and you really have to, buyer beware even in annuities, right, Jonathan?
Yeah, or especially annuities. I mean, personally, I haven't yet purchased any, apart from the annuities I have in my employer pensions and old age security now here in Canada. But I don't. I think it depends. I think variable annuities and the annuities sort of tied to the market, they can be a little bit costly. That is true. But I think you can certainly investigate the market and try to find a bargain if you can through a proper financial advisor who's got your best interests at heart. And if you do that, I don't think you need to shy away from them totally. All I'm saying is they should incorporate them as a portion of your approach to drawing down investment income or retirement income.
Have you seen the commercial on CNBC where a guy named Ken Fisher says, annuities, I'd go to hell before I would sell an annuity? Have you seen that one?
I haven't seen that one, but
maybe they only show it in the U.S., Jonathan. But obviously he's selling, his services. I think he's an RIA, and charges a percent of assets under management. But he's basically saying, it's mainly in the salesperson's interest, and they could duplicate what you do in an annuity with their products. So anyway, I just wanted to touch upon it. Your annuities don't get that kind of bad press up in Canada, obviously.
Perhaps not as we're aware of the bad press, and I think maybe the press is a little bit more is worse reserved. The fact most
Just lost you, Jonathan.
Oh, can you not hear me? Or you've
Okay,
lost
better
me
now.
conceptually.
Better now.
Okay. Yeah, no, I was just saying that I think most financial advisors are probably compensated based on their percentage of assets under management. For them, ironically, that's their annuity to have a couple hundred clients all paying them 1% of their portfolios. So naturally, they don't want to lose that money to an insurance company. Right. I'm not, particularly flogging annuities. I haven't actually bought them myself. I think at some point I may, and that's about the extent of it. And I only responded because you asked me what I thought.
Okay. So let's talk about what everyone has, debt and frugality.
Well,
One of your headings there. Go ahead.
Well, to me, as I say, the foundation of financial independence is a paid-for home. So I don't even believe in going into retirement with any debt, not mortgage debt, no credit card debt at all. I'd rather own the credit card companies, Visa and MasterCard, and be the collector of dividends based on people in debt than be the person financed. I'd rather be the recipient of fixed income, not the disher outer of it. So, maybe.
So debt is bondage. Debt is bondage.
In my opinion, now I realize in the States that you can deduct your home mortgage debt from your taxes, and there's a real reason to continue to have a bit of mortgage debt. That's not the case in Canada. So Canadians are sort of trained to get rid of the mortgage as fast as possible. Plus, we're not as big risk takers, so we tend to shy away from even credit card debt, and particularly if it's at 20%. I mean, there's no return that I know of that's guaranteed at 20% in the stock market that equals the return from just getting rid of high interest debt.
Our president brags that he's the king of debt. What's it look like from Canada? With what's happening here in the States, Jonathan? Go ahead. Well, you can be straight with me.
We pay a lot of attention to the Trump administration. I mean, I watch CNN as much as I watch Canadian shows. I read the New York Times and Wall Street Journal as much, and it's basically all Trump all the time. It gets a little tiring, of course. I don't know. He's got some very raw instincts, and sometimes he seems to be able to turn it into gold. But it remains to be seen. I mean, they're already tromping away at trying to get a second term. I think they're starting to talk about it. I don't know. I mean, so far the market has responded relatively positively. It seems to be a little bit on hold right now with this whole tariff stuff. I mean, I know there's a 1 month reprieve right now with Europe and Canada and the things. But I would say that the fear of a severe market correction that we saw in February, March has not yet dissipated, and Trump isn't helping any. The tax cuts sort of help, but if you read Paul Krugman in today's New York Times, he's pretty skeptical that the tax cuts have really significantly contributed to economic growth thus far.
Yeah, they definitely contributed to a parabolic move in the market into January. Yeah, I've been reading articles for years about here in the States, the safety of pensions. A lot of these pensions have been squeezed over the years because of low interest rates and being forced to out on the risk curve, and they needed like 7, 8, 10% just to break even with their pension. Do you have any view or any advice for someone who might be worried about his pension down the road being what it is today? Is there anything someone could do about that?
It depends where you are. If you started to collect the pension already from an employer, it may not be possible to do much. If you're approaching retirement and you still have the option of commuting the value and taking the value of the pension, putting it into your 401k or into your IRA, that is an option. I don't recommend it. I think that for the most part, pensions are run relatively prudently and at a relatively low cost, often lower than 401ks. But it always depends on if your employer, like you mentioned Trump. I mean, if you're part of a debt-ridden organization and you think that there's a chance that the pension fund may not be there for you, then yes, I would take the cumulative value, at least partly.
Well, I mean, it's not just companies. How about states, like the state of Illinois? A lot of the, a lot of these pensions are making people take cuts in what they originally promised people.
Well, they call it the pension promise for a reason, but if they're breaking the promise, there's not much. If you're a state employee and you've been in your career 30 years in a particular state's pension plan, you're basically, you can't really negotiate it. You're helpless. You're depending on a promise that somebody may not make. Now, there is, of course, and you could tell me if I'm wrong, the pension guarantee fund. We have one not across Canada, but only.
It's so low. It's so underfunded. It's almost comical. If there was a problem.
Yeah, if you want to be really negative, you could get really paranoid and say even Social Security is not going to be there, my pension is not going to be there, the market's going to crash. I mean, we could all put our heads in the sand and like, oh, woe is me. I think you got to have a little bit of positive, hoping things will work out for the best. Otherwise, there's a rock wherever you look. There's going to be of these horrible things happening. I don't think the average municipal employee or government employee in a pension plan should. I mean, in Canada, we mostly envy anybody in that kind of pension plan because it's basically backed by the taxpayers. But again, I mean, the more you can get your assets under your own control, and then if you properly asset allocate, like the Vanguard asset allocation funds I mentioned, so that you have 50 or 60% fixed income or as much as 60% equity. I mean, diversification is the only free lunch. Diversification globally across asset classes and geographies, plus products, as I said. So you have some money in the financial markets, some money in annuities. Hope that the Social Security promise will be there. It should. I mean, at least Trump has not threatened. That's the one thing he's been pretty consistent on. He's not going to go after Social Security. So at least we can probably sleep better at night with that realization.
What do you favor in a rising interest rate environment that we're finally in?
Well, again, a balanced portfolio. You don't want to have
bond-wise.
Sorry?
Bond-wise.
Yeah. Well, I personally, I put a lot of my fixed income in 2-year GICs. You would call them CDs, certificates of deposit.
Okay.
Rolling over every 2 years because they pay better than a 1%, than a 1 year, and certainly better than the T-bills. But at least, and they're going so cautiously and slowly. We know what they're going to have 2 or 3 more rate rises this year. It's always by 25 basis points. So even a 2-year commitment would mean only maybe a 1.5% higher a year and 2 years from now. And at that point, if rates are higher, then you go, ladder it out to another set of 2-year CDs. There are also fixed.
It's actually good for savers, don't you think? I mean, for all this, better, not great for savers, but better than it was, where banks were paying 0.25 or.
Oh, it was terrible. It was called financial repression. The savers and retirees were prudent and didn't go to the market were punished with, as you say, almost zero interest rates. At least now you can get maybe 2 or 2.5%, and if the rates sort of inch up more, then maybe you get 3 or more. There are also fixed income ETFs, exchange traded funds. There, I would keep them into shorter term ones, the ones that don't have too long a duration. Same idea. You don't want to commit to 10 or 20-year time horizons because, as you know, if rates continue to go up, the value of those bond ETFs can go down. I think a lot of retirees are shocked to see even medium-level fixed income ETFs have sort of been down in value. They appear to be down in their capital value, even though they sometimes don't factor in the interest payments that are being made. And then, of course, equities. I mean, obviously, most retirees are going to need stocks or equity ETFs with companies that are growing their dividends, because inflation is always the big bugaboo. I think right now the Fed is sort of acting as if it's about 2% inflation, which gives you another idea. TIPS, Treasury Inflation Protected Securities. We haven't had a lot of talk about them in recent years because inflation's been so dormant. But I would say, again, if you're going to have some CDs, some short-term fixed income ETFs, and the third element would be the inflation hedge, which are TIPS or Treasury inflation.
Okay, your native currency has been pretty volatile over the last couple of years. Do you pay attention to what the loonie is doing, Jonathan?
Well, of course, once upon a time, Canadians were forced to invest 70% of their equivalent of the IRA in Canadian securities. You know, what we have in Canada is we have something called Canadian banks. And so, I mean, I invest a lot in your FANG stocks, for example, in the U.S., a lot of U.S. stocks, but I don't feel a need to go and buy, Bank of America or Chase Manhattan or anything like that, because the big five Canadian banks are like money machines. I mean, they consistently pay 4% dividends. In fact, sometimes there was articles in the Canadian press that why would you have anything else but a Canadian bank stock? My father-in-law was a dairy farmer, and he figured all he needed was the milk quota and Canadian bank stocks for his retirement. Then, of course, and then Canada has a lot of resources and energy things.
Right.
That's been a little dicey because we have companies with like Enbridge and TransCanada pipelines, and we've had all these problems with the Trudeau administration kind of blocking various pipeline projects. So, and then of course, you guys haven't made it easy for us because the taxes are coming down, and the corporate tax in the States is making Canada less competitive from a tax perspective. Money is starting to flow out of the country, and so people are a little nervous up here.
Okay, let me ask you, in Canada, is there a cryptocurrency craze going on up there?
Oh, yeah.
Any comment on it?
It's everywhere. You know, I've not invested in any of that stuff. I mean, personally, I still prefer gold as my hedge currency. When we were talking about tips and inflation, I've always thought maybe a 10% position in gold, or at least precious metals or precious metals or bullion ETFs was prudent. Whether crypto is going to replace gold, I don't know. I just rather wait and see. The real big craze, of course, in Canada, apart from crypto, is marijuana stocks, which are starting to creep over the border there as well. But Canada legalizes in July, and I know in California and about 8 or 9 states, it's the same thing is happening. Personally, I prefer to play the marijuana thing through ETFs with a tiny portion of my net worth. Hasn't worked out great so far. And there are sort of a lot of these quasi kind of, you can invest in, Altria and some of the tobacco companies or Constellation Brands that recently bought a minority position into Canopy Growth. I think another one is, Scott's Miracle Grow is another one. So there's a various sort of marijuana plays that aren't necessarily committed to marijuana itself. But personally, I find that a little more promising than cryptocurrency. I just don't understand cryptocurrency. I don't think 65-year-old guys should be messing much with cryptocurrencies. Do you, Dale?
I have a hard time wrapping my head around it too, and price discovery. So, but I am attempting to edify myself in them, because everyone's saying blockchain is here for good. Whether Bitcoin's the king or something replaces it, that's another story. But what a great interview, Jonathan, and really I've enjoyed getting back together with you. During our interview, and you brought up marijuana stocks, I'm staring at this pretzel rammy pastrami sandwich on your website, the top ad from Togo's, and looking forward to lunch now. Just talking about marijuana stocks gives me the
one of our advisors, Pat McHugh, recommended PepsiCo as a related marijuana play, because people who get high get the munchies, and so they're going to go for the snacks the Pepsi sells. So you can think creatively about how to play that play. I can't think how to do it.
And someone in our community said Canada manufacturing PM doing 7 minutes. Do you think Canada is going to remain strong? I mean, with higher energy prices, it should help, even with the real estate market bubble beginning to give way in Toronto.
Well, Toronto and Vancouver is still pretty pricey. Personally, we have a house here in Toronto. It's paid for, but we bought it like 25 years ago. So we're sitting there. We got a capital free gains on there. So a lot of Canadian retirements are riding on a paid for home. I don't worry too much about it. As I said, the Canadian banks are very strong. Remember in the 2008 recession, or whatever you want to call it, financial crisis, it was the U.S. bank stocks that were and financial firms that were leaders. Canadian banks came through smelling like roses. So I can't imagine. I mean, it's like a monopoly because they're all, unlike having a lot of small local regional banks in the States, all the Canadian banks, all the big 5, 6, are all national across. Now, it's true it's a country 1/10 the size, but they are as stable as heck. You can't go anywhere without seeing 2 or 3 Canadian bank branches in any street corner. So 4% dividend, I'll take them. They keep on growing them, I'll take that as well. I don't worry too much about the Canadian market. I certainly like, I love owning Amazon and Google and Facebook and all that stuff. But we're allowed to own all those stocks as well. So we do.
Well, I'll tell you what, Jonathan, if people just listen to your tone of voice and demeanor on this interview, they could tell how relaxed you are and what kind of conviction you have, that you put your mouth where your wallet is. And I think it's really a great mission that you have for people, because a lot of people have fallen through the cracks and are going to have uncomfortable retirement. So what a great mission, so that people could enjoy their golden years instead of struggling during that time in their life.
We call that victory lap retirement. That's the victory lap. So as you sort of go down in the glide path, it can help you.
Okay, well, it's obvious to me, Jonathan, you're enjoying this time in your life, that you're, enjoying your victory lap. I hope you have years of victory laps ahead of you, and that you touch a lot of people and help them enjoy their years later on, instead of having to depend on something like Social Security. So congratulations in your mission, Jonathan.
Here on in.
Okay, lost you for a second.
Yeah, no, I just said I hope we can do this in the future, every once a year or two, and update the progress of our victory lap here.
That's a promise, Jonathan. Thank you so much, everyone. That's Jonathan Chevreau. Here's his website, www. Financial Independence Hub, and you could follow him on Twitter at John Chevreau. So that's it for Turnaround Tuesday, everybody. Enjoy the rest of your day. See everyone tomorrow. And remember, don't just count your pips, count your blessings, and think long term, not just short term, about where you want to be with your family and your spouse when you're the age of Jonathan and me. Adios. Thank you, Jonathan.
Thank you, Dale. Anytime.
Okay, buddy.
Okay. Bye-bye.